All right, we are on chapter 9 and we're picking up. Chapter 8 was about inventories, and now we're going to be talking about some more issues that revolve around inventory. Okay, so first thing, kind of talk about what happens when we buy inventory, put it in our warehouse. Things can happen to that inventory. It could be damaged. It could be physical deterioration. Like I always think of food. Food's going to go bad at a certain point, chips. So they expire. There could be obsolescence, and that just means whatever it was. I think of like computers. Computers used to change faster than they are changing right now. So it was very common to buy a computer and then that computer really be obsolete 6 months to a year. Kind of a little bit different. Things aren't progressing quite as fast now. We've kind of plateaued. So you don't see that quite as much as you do. But if you have computers, iPhones sitting in a warehouse somewhere, not being sold, and they will eventually become obsolete. Okay. And there can be changes in price levels. And all of these things reduces the ability to sell it. Okay. So we're going to look at inventory on writing it down because remember conservatism. Conservatism tells us that we need to give the worst case scenario, okay, when it comes to inventory. Okay, we have two approaches right here. We are going to go through an example of both of them. Okay, and you have some homework problems also to do that will help reinforce that. Okay, so the first one, lower of cost or net realizable value, is what LCNRV means. Let's talk about what is NRV. NRV is net realizable value. It is the estimated selling price minus any cost of completion, disposal, and transportation. Okay. That could be a really small number on that cost of completion, but if it is something like a vehicle that's going to be sold, like a commission that a salesperson is going to earn, that would fall underneath that cost of completion and disposal. Okay. So, because we're trying to make sure that we can at least sell it for what we have it on the books. We hope it's more because that's what we're in the business of doing, selling it for higher than what we bought it for. That's how we make our revenue. But if that value drops down, then we're going to have to lower the inventory cost. Okay. Cost is just what is on our books as. Okay. Cost, books. Think of those two things together. That's what we're carrying it at. Okay. So here we're going to look at, and we can apply this um, as a whole. They do all three of these by individual items, major categories, and by inventory total. We're not going to look at these two right now. Okay. So let's look at each individual one. So they told us the cost was 50,000 and they gave us the net realizable value. They will not give you the net realizable value on all the problems. Okay. They might throw it in and make you find the net realizable value. Okay. So this is pretty easy. Cost is at the lower amount. We leave it alone. Okay. We're already carrying it at the lowest amount possible. So we don't do anything with that one. Okay. B has net realizable value of 90,000 and a cost of 100,000. So we're carrying it at too much value because we're not going to get $100,000 for this. We hope we get 90,000 for it and we completely break even. Okay. So notice the smaller one is going to this column. Okay. 50,000 and then the 90. Okay. Let's jump down to item C. We're looking at 80,000, 75. 75 is the smallest one. So we're going to put that right there. Get down here to item D, 90,000 versus 85. 85 is the lower. And then we have cost on item E, cost 95, net realizable value of 96. We're going to go with the 95,000. Okay. All right. So these ones that were being carried at the cost, we really don't have to worry about anything. We're already carrying at the lowest amount. the ones that we do need to adjust down, those are the ones we will make a journal entry for. Okay. So they added up all of those, but notice this one and this one was the cost. It was already, we're already carrying it at the lowest amount. Okay. So if we look at 395,000, that's what we did. We did it by individual item. We're carrying on our books at 415,000. So we need a write down of 20,000. Okay. I'm going to come back and do those major categories. I want to kind of come down here so you can see the journal entry that needs to be made. Okay. So I love that they gave you a T account for inventory. Remember, it has a normal debit balance. So when inventory is being decreased, which is what we're doing right here, we're going to credit inventory. Okay. So we're going to debit cost of goods sold, credit inventory. It looks just like the entry that we made when we're selling a piece of inventory. Okay. But we're just lowering the dollar value of the inventory we have. We're not really selling it, but just so you can kind of put those two together, that is that exact same journal entry. Now, that this could be common. That might not be material amount. Okay. If it was a lot, like people made mistakes in counting inventory, we got big issues. Okay. Then they would debit some sort of loss, like an unusual, infrequent loss, and that will go somewhere else on the income statement because it kind of, we separate it out because it's something out of the normal, it's unusual. Okay. So, but if it's just common, write down, that's the journal entry we're going to make right there. Okay. So let's come back up here and we're going to do it by categories. So the categories kind of helps offset. So you can kind of see right here on that first one, totaling A and B together. You can see the gain up here in item A, not really gain, but that difference offsets this one by more than what we're carrying it. So when we get to the cost versus net realizable value of that segregated little major category, the lowest is 150,000. If we had added these two together, that's 140,000. Okay. So you see how you're getting different numbers when you apply it per item or per major category. Okay. So we're going to do the same with C, D, and E. We look at their totals. We have net realizable value of 256,000. Cost, we're carrying it too high. So we're going to write it down to 256,000. Okay, we've got to write it down some. Now we're going to compare this number to the 415. They don't do the journal entry on these slides for all of those. It's the exact same journal entry, just your amount is going to be different here, okay? All right, and then the easiest one, okay, is just total it all up, okay? Again, this works really good. We don't have to do a lot of thinking with it. It's sort of one inventory item being a little bit off, sort of balances out with other ones on the other way. So you look at your 415 compared to your 406, and that's a lot less difference, right? That's only what, $9,000. Okay. 9,000 versus 20,000 when we did it per unit. Per unit's probably the better one, but sometimes you're in a hurry. Okay. And sometimes you need a number and you need a number fast. A lot of times they'll use some of this for interim reports. So they might use the total for like interim, quarter one, quarter two, three. And then they may do a more individual items when they have their year in. Okay. All right. So we already did that one. That was a journal entry. I'm skipping these little multiple choice questions. If you want to pause the video and work that, go right ahead. Okay. I'm going to kind of skip over the gap things. They do this in this textbook. They give us a little bit of window into IFRS versus US GAAP. And I know I have a few students taking this class who are also taking international accounting, so you're getting to hear it twice. Okay. US GAAP, once we write that inventory down, they do not permit any write-ups. Okay. IFRS actually will let you write it up. Okay. So they may indicate that the write down is no longer appropriate, so it could be reversed. I believe, if I remember correctly, it can only be reversed up to what it was before. You can't do it for more than that. Okay. US GAAP can be applied. We did it on the individual items, categories, and the entire inventory. Okay. For IFRS, it's usually applied to individual items. Okay. All right. Another little concept question. All right, so now we're going to do LCM, lower of cost or market. Okay, a little bit different than what we just did. This might be the harder one, but once you kind of get in the groove of doing it, it does have a lot of numbers in it. So just knowing what those numbers are and these definitions. I know this is not really a definition class, but knowing what net realizable value is, knowing what the NRV minus the normal profit margin is the floor. So they call this the ceiling, the floor, and then market. Market is what we can go out and buy that unit again. Okay, we can buy that unit again for that amount. Okay, so we're going to compare the cost. Remember, cost is books. That's what we're carrying it on our books as. Okay, we're going to compare that to these three numbers. We're going to take those three numbers. We're going to find the number in the middle. Middle is your number. Okay. So that's kind of hard to explain. So let's come down here. All right. We have to this is where I told you they'll make you calculate net realizable value, and net realizable value is the same as it was in the previous one. We're just calling it the ceiling right now. And then our floor will be the NRV minus the net normal profit margin. Okay. So let's look at item A. I think I might have, no, I thought I had pulled one over to work. So we start with a selling price minus any estimated cost to sell. So our NRV is 85 minus the normal profit margin is 20,000. Okay. They took 20% of the 100,000, not 20% of the 85. And so now my floor is 65,000. Okay. So my ceiling is 85K and my floor is 65. Okay. Okay. Now we're going to go up here and they're going to give us that replacement cost, which was 55,000. So I probably should just pull these down. Ceiling. And this keeps us from lowering the amount too much. Okay. Okay. And then replacement or market for this unit was 55,000. Okay. Don't look at the cost just yet. Remember, cost is what we're carrying on our books as. Okay. So the easiest way for me to do this, I always like to find the highest number, find the lowest number, and there's my middle number is 65K. Okay. So that is my market. Okay. Well, I'm sorry. I told you market right here. I don't want to confuse you. That's replacement cost. Sometimes they use those synonymously. Okay. All right. So, we've got our middle number of 65,000. We're carrying it on our books as 50,000. We're already carrying it on our books at the lower amount, so we do nothing for this one. We don't do anything for this particular unit. I know that was a lot of work to say, oh, we're already carrying it at the lowest amount. Okay. That's just GAAP's process. Okay. So let's go through another one. B had a selling price of 120 minus any estimated selling cost gives us our ceiling of 90,000 minus the normal profit margin gives us our floor. Okay. So we're going to come down here. Our ceiling is 90K. Our floor is 66K. And our replacement cost is 97. I'll make sure I put replacement cost. Replacement cost is 97. Okay. All right. Again, find the lowest number, find the highest number, and then take the one that is in the middle. Okay. If you exclude the highest and the lowest, there you have your middle number. Your middle number is the market, that is 90,000. Okay. We're carrying that unit on our books as 100,000, but we just figured out that our market is basically 90,000, so we are carrying it too high. We're going to have to write that unit down some. Okay. Let's do one more of these. Okay. And you can stop the video and you can work all of them if you want to. Remember, you can find the PowerPoints. I just have these imported over into OneNote so I can do it, just stay on the same screen. You have access to the PowerPoint so you can pull them down. Okay, so let's do the next one. Unit C. We have a selling price of 90,000 minus any estimated selling cost. Here's our ceiling minus the normal profit margin. Here is our floor, and our replacement cost for unit C is 70,000. Okay, so we have, tell you what I'm going to do so I don't have to keep writing things over and over again. Our ceiling is 75K. Our floor is 57K. And our replacement cost, oops, come back here. There we go. Our replacement cost is 70K. Okay. There's our low, there's our high. Here is our market, is 70,000. Okay. So we're carrying on our books at 80,000. Our market is 70,000. So we're going to lower that one. It's not being carried at the lowest amount. Okay. So that was slide 11 and 12 where they did all of that. You can see once they do all of those, you can see where the total from what the cost is and what it should be on the lower of cost or market. It's going to be a little bit different than what we did in the previous problem, so don't get those two confused. Okay. All right. Adjusting entry is going to look exactly the same as it did for the first one. Okay, that didn't change. The only thing that changed was how we found the number, and we found 28,000. Up there in the other one, I think it was 20,000, right? Okay. So remember, if this is a common one, that's fine. We're going to record it just bringing the value, the dollar value of the inventory down. If it's a lot, we're going to use a loss on inventory, and it'll be like an unusual, infrequent event. Okay. So there can be aggregation at different levels, which would make some of your numbers a little different. So there could be some potential for fraud, but like I said, most of the time this is going to be used during the interim, probably not at the year end. So audited financial statements are probably going to be okay. We always assume quarterly financial statements are not 100% accurate because there is not a full-blown audit done at every quarter. Okay. But there is an audit done at the end of the year. Okay. All right. That is all for this video. If you want to pause it right there and work on that last little problem, you are free to do that. I will see you in the next video.